The company that calculates your credit score brought in $1.99 billion last year. You, the person whose behavior generates every data point they sell, received exactly $0 of that. The source is FICO's own 10K filing, November 2025, public record. And the thing is, nobody asked you before they built a three-digit number out of your financial life and sold access to it. The system just appeared in 1989, and by the time you were old enough to have a credit card, the number already existed, already mattered, and already had a price tag on it, just not for you. Here is what most people believe about credit scores. And for the first half of this video, I am going to argue that they are right. The standard story goes like this. Before credit scores, getting a loan was about who you knew. A banker looked at your face, your address, your last name, and made a judgment call. Redlining was not a metaphor. It was a literal red line on a map. Entire zip codes were cut off from capital based on the demographics of the people who lived there. The FICO score introduced in 1989 was supposed to fix that. Replace the banker's gut with a formula, replace bias with math, and on paper, it worked. A 34-year-old dental hygienist in Indianapolis making $68,000 a year can walk into a credit union today and get the same interest rate as anyone else with the same three-digit number. That is the promise of the system. The number does not know your race. The number does not know your gender. The number does not care whether you went to college or dropped out at 19. It looks at 5 categories: payment history, amounts owed, length of credit history, new credit, credit mix. That is it. And if you play the game well, the rewards are measurable. Take two people shopping for the same car, same dealership, same model, same 60-month loan on $30,000. One person has a 790, the other has a 490. According to Experian's State of the Automotive Finance Market Report for Q3 2025, the 790 gets an APOR around 4.66%. The 490 gets hit with something closer to 16%. Run those numbers through. The person with the higher score pays roughly $561 a month. The person with the lower score pays around $730. Over 5 years, the gap in total interest is more than $10,000 on the same car from the same lot. Nobody talks about that math at the dealership. And it goes further than cars, homeowners insurance, auto insurance. In more than 40 states, insurers are legally allowed to use a version of your credit data to set your premium, according to the National Association of Insurance Commissioners. The score follows you into the HR department, too. A significant share of employers in the United States include a credit check in their hiring process. Not your score exactly. They see a modified report, but the data is the same data flowing from the same system. So the system matters. That part is real. You checked it last month, probably, maybe on your phone, late under the covers. You saw the number. You did not know exactly what moved it up, 3 points or down 7, but you felt something, relief or dread. Nobody was in the room. Nobody saw your face. And this is where the story is supposed to end. You have a number. The number is fair. The number rewards good behavior. Go forth and be responsible. Except that is only the version of the story the system wants you to hear. And this is all publicly available data and math, not personal advice for anyone's specific situation. But the numbers behind this system tell a story that is hard to walk away from. Let me introduce a second way to look at the same machine. Think of the credit score as a toll booth. You built the road. You paved it with every on-time payment. Every credit card balance you kept below 30%. Every month you resisted closing that old account because someone told you the age of your credit history matters. You built the road. The toll booth was installed by someone else, and everyone who drives on your road pays them, not you. That is not a metaphor. That is the revenue model. Start with FICO, Fair Isaac Corporation. They invented the score. They license it. Every time a lender pulls your FICO score, FICO collects a royalty. In 2023, that royalty was structured in tiers, ranging from 60 cents to $2.75 per score. By the end of 2024, FICO notified the credit bureaus that the new wholesale price for mortgage-related scores would be $4.95 per pull. Then, in October 2025, Equifax issued a public statement disclosing that FICO was raising the price again to $10 per S-score for 2026. That is a roughly 1,500% increase from the low end of the 2023 tier in 3 years. FICO S-score segment alone generated $1.169 billion in fiscal year 2025, per their annual report, up 27% from the year before. The entire company brought in $1.99 billion, and here is the part that should break your brain. FICO does not collect your data. FICO does not store your payment history. FICO does not verify whether you paid your electric bill on time. They built an algorithm. They license the output. The data comes from somewhere else. It comes from the credit bureaus. Now let me say that again because it matters. FICO charges lenders for the right to see a number that FICO calculates using data that FICO does not own about a person who never agreed to any of this classic. But here is the part that should make you sit up straight. Everything I just told you, that was the surface. The credit bureaus are not just infrastructure. They are not just pipes carrying data from point A to point B. They are publicly traded, profit-driven companies. Equifax reported $6.075 billion in revenue for 2025. Experian reported $7.52 billion. TransUnion brought in $4.58 billion. Add those up, the three companies that store and sell your credit behavior generated roughly $18.2 billion last year, according to their public filings. $18.2 billion. That money does not come from you paying your bills. That money comes from selling access to the fact that you pay your bills or that you do not. And they do not just sell your credit report to lenders. They sell marketing data, they sell pre-screened lists. They sell what the industry calls trigger leads. Here is how that works. You walk into a bank and apply for a mortgage. The bank pulls your credit within hours, sometimes minutes. The credit bureau sells that inquiry to competing lenders. Your phone rings. You have not told anyone you are house hunting. But somehow, 4 mortgage companies already know. They bought the lead from the bureau. That processed the pull that you authorized for one specific purpose. Think about that toll booth again. You built the road. They installed the booth, and now they are selling tickets to the traffic pattern. A person in Tampa, 29 years old, working as a claims adjuster, making $62,000 a year, decided to start shopping for a condo. They had been careful, credit score 741, saved $31,000. Spent 2 years saying no to trips, no to the car upgrade, no to the apartment with the second bathroom. They applied with one lender. Within 48 hours, they got 11 calls from lenders they had never contacted. They did not understand how. They assumed there had been a data breach. There had not been. The system functioned as designed. Their credit inquiry was packaged, priced, and resolved before they had even gotten a rate, quote, back from the first bank. By any reasonable standard, this is exactly the consumer the credit system was supposed to protect. Here is what the system offered in return: 11 unsolicited phone calls, and the quiet sale of their financial intention to the highest bidder. And nobody in this chain committed a crime because the system was not broken. It was working exactly as designed, just not for the person whose data made it possible. Now, I want to zoom out because if you are only looking at credit reports and FICO scores, you are still only seeing part of the toll booth. The insurance industry uses your credit data to set premiums, not your FICO score exactly. They use something called a credit-based insurance score. Different formula, same underlying data, same bureau, and the bureau gets paid again. A different product, same raw material, your behavior, your payment history, your utilization rate, repackaged, rescored result. Employers use it too. They see a modified version of your report. Again, the bureau gets paid. The data is the same data. The person is the same person. The person still got paid zero. Let me walk you through what the full chain looks like when a single consumer does something. As ordinary as applying for a car loan, you apply. The dealer pulls your credit from one or more bureaus. The bureau charges the dealer a fee. The bureau pays FICO a royalty for the score attached to that pull. The bureau takes your inquiry data and may sell it as a trigger lead to other auto lenders. If you get the loan, the interest rate you receive is partly determined by the score. If your score is lower, you pay more interest. The lender earns more. If your score is higher, you pay less interest. And the next time you apply for insurance, the insurer pulls your credit data. pays the bureau again, and gives you a rate shaped by the same information. Your landlord might pull it too. Your employer might pull it. Every single pull is a transaction. Every transaction generates revenue for them. You are not the customer of this system. You are the raw material. That is the toll booth. You built the road. You maintain it every month. And every entity that touches it, FICO, the bureaus, the lenders, the insurers, the employers, they all pay each other for access to a road you paved with your own behavior. The only person who does not get paid is you. The U.S. credit agency market was valued at $18.77 billion in 2025, according to Mortar Intelligence. FICO, S-Scores segment alone is growing at 27% year over year. Credit card debt reached $1.28 trillion in Q4 2025, a record, per the New York Federal Reserve's quarterly report on household debt and credit. Every dollar of that debt generates data. Every data point feeds the bureaus. Every bureau feed generates revenue. The more debt consumers carry, the more data flows. The more scores get pulled, the more money the system makes. Let that sink in. The system does not need you to have good credit. It does not need you to have bad credit. It needs you to have credit, to use credit to generate activity, because activity is inventory and inventory is revenue. Even for me, and I assume the worst about these systems, this one was hard to look at. There is a version of this story where the credit score is a public utility, a number generated from your behavior, maintained by a nonprofit, available for free to any institution that needs it, with no resale of your data. No trigger leads, no billion-dollar licensing fees extracted from the act of measuring. Whether you paid your electric bill, that version does not exist. What exists is a roughly $20 billion industry built on top of your financial behavior, selling access to your patterns to anyone who will pay. The score is not your report card, it is their inventory system, and you are the product on the shelf. Now, I am not telling anyone to do anything specific, but here are the mechanisms that exist in the system right now. You can opt out of prescreened offers by calling 1-8885 opt-out or visiting optoutprescreen.com. That is administered jointly by the bureaus under federal law. It reduces trigger leads. You can freeze your credit at all three bureaus for free. Under federal law, which does not affect your score but does restrict who can pull it, you can request your free annual reports from each bureau at annualcreditreport.com and dispute inaccuracies. These are not secrets, they are mechanisms. But the system was not designed to remind you they exist. The credit score was introduced in 1989. It is now 2026. In 37 years, the system has generated hundreds of billions of dollars in cumulative revenue for the companies that own, calculate, store, and distribute it. The consumer whose behavior makes the entire system possible still does not receive a single dollar of that revenue, still does not get a say in who buys the data, still gets 11 phone calls after applying for a mortgage they have not even been approved for yet. Here's the question the system does not want you to ask. If your credit score is calculated from your data, generated by your behavior, updated by your choices, used to determine the price you pay for a car, a house, an insurance policy, and a job, then whose product is it, really? And why is the answer not you?